To our audience, welcome back to Boutiques on Wednesdays, where we keep you up to date on the most recent developments and bring you some of the top boutique managers. Global markets welcomed the Fed rate cut last week as US labor markets and inflations are cooling. The South African Reserve Bank followed with a more cautious approach, announcing a 25 basis rate cut. Will we see a reversal of capital flows from the US, and is this the boom for emerging market policymakers we've been waiting for? And how does this translate into earnings growth, especially South African equity, which we will focus on this morning? Here to unpack their views on SA equity, it's my absolute pleasure to welcome Kobus Salia, equity analyst at All Weather Capital, the style agnostic fund manager, allowing them to adapt to various market conditions and cycles. Good morning, Kobus. How are you doing?
Very good, and you, Eugene. Thank you for having me.
Yeah, thank you for joining us. Really great to have you on. Second time on Boutiques on Wednesdays. We know All Weather Capital by now. Shane presented at several of our functions as well. And really keen to look at your views on SA equity and the unique themes you are playing at the moment and the questions you are asking.
Perfect, great. Thank you very much, Eugene. Let me kick off. Always good to have to start the morning discussing SA equities, or something that all of us at the firm are very passionate about. So to maybe start off, the presentation today is just going to start off. I'm just going to have a brief introduction about our firm. Then we're going to move on to some in-house research that we've done more on the macro side and how that relates to our South African SA equity investments and how that translates into how we focus on our research. Then we're going to focus, just going to switch over to some specific themes that we look at, some areas that we look at to create alpha for our clients, which is quite interesting. And I'm going to delve into specific stock ideas and relate that back to some of the meetings we had at the RMB Big Five conference. We sent a full team down there. And then lastly, just touch on a few other specific SA equities that we are long. So with that, let me kick off. So just All Weather Capital is if you can focus on the middle or the top right slide. Essentially, it's if I look at the top right slide, we are very much focused on SA equity, global emerging markets, and hedge funds, which in itself is something that we're quite passionate about. If I think about how long we've been in this industry and how we've done the hedge funds and the SA equity specifically, it is something that we've got quite a deep knowledge of. And if you look at the middle, the intrinsic value philosophy and the style agnostic is also something that is important for us, because when it comes to more specifically, when it comes to different cycles, if you look at the interest rate cycle, how people are investing, it's having a specific style is sometimes very good when it comes to selling, having a story to tell. But for us, it's very much about outperformance. And sometimes you have to change slightly with regards to what direction the cycle is selling, whether it's the interest rate cycle, whether it's a fixed capital formation investment cycle. The one analogy that someone always uses is in our firm is, if the wind's coming from the front or the back, you still need to be able to go forward on your ship. Then just moving on to the next slide, and I think this is also something that we're quite happy about with regards to how we are able to outperform in the SA equity landscape. So looking at our firm, like I said, we've got quite significant expertise in the equity space. That is our core. That's where we started from. And the nice thing about it is, if I look at the depth of knowledge on the equities, that's why the SA equity, the top bubble is why it's so significant for us. Then on the hedge fund mentality, I'll go into a specific example where we played both the hedge fund, where we churned a little bit more, and then obviously on the long only side, SA equity, that also worked for us. But on the global emerging market knowledge, we have a specific team that looks at that. And SA within the larger emerging market space is also quite important for us, because if you look at what happened yesterday in China with the stimulus with regard to the rate cut, I mean, there's quite a lot of things that impacts South Africa. I mean, when the market opens, obviously we're going to see nice person process run quite strongly. But just to have that overlay with regard to where SA South Africa is within the larger space, as well as the commodities that South Africa exports, how that impacts South Africa corporates. There's a variety of reasons where that knowledge gets shared. So that's something that I think we as a firm do fairly well, and it's definitely a unique selling point for us. Then just on some of the funds that we do, these are the funds that we had 5 years ago. So our 2 hedge funds are long short, as well as our market neutral funds, as well as our all-weather BCI equity funds. And to be honest, if you look at the BCI equity fund, it's an institutional product mostly. It's a product that's got a very low tracking error. My next slide actually alludes to that, but it's a fund that's very good for institutional investors, but maybe not always what the retail audience are looking for. But be that as it may, given the fact that we've got the hedge funds, that might be something that retail audiences nowadays are a little bit more open to. And then as we've gone through the years, we've opened up quite a fair amount of funds, unit trusts. We started with 3 5 years ago. We currently have 8. The firm itself has gone from 8 billion AUM 5 years ago, currently just over 25 billion. And the staff complement's also gone up quite significantly from 8 5 years ago up to 24. So nice growth for the firm, nice performance for the funds as well, and also growth in asset classes, which is something that's important for us as well, because when you start to look at the bond fund, and when you start to look at multi-asset, how that relates with regard to the other asset classes, and for South African equity specifically, it's quite important to have that knowledge when you make a decision on where to deploy your investors' capital. Just the 2 equity funds that we have, we've got the all-weather BCI equity fund, which I mentioned is more institutional type of fund. It's run by our Chief Investment Officer, or Deputy Chief Investment Officer, as well as one of the analysts. So it's Prince, it's Sunny, and it's Shane. Run quite long with a decent track record, good track record. But once again, low tracking error, very benchmark cognizant, not taking too much active risk. And with that said, we decided to open up a much more active equity fund, and that's why we started the all-weather BCI Best Ideas Equity Fund. We launched that in April. It's currently sitting at 50 million AUM. It is a unit trust, and we always the mandate essentially is we have 25 or less equity investments in that fund. It's got a very high active risk. It's got a high tracking error to the benchmark, and we are essentially big benchmark agnostic, which I think is something that's a little bit more sexy. It's a little bit more racy, and it's done fairly well for us since inception. And I would love it if everyone in the audience goes and looks at the league tables once it was obviously published for August, and once it comes out for September, check us out where we're at. We're quite happy with that. Then moving on to our in-house strategist. So this is our so Nick van Rensburg is our investment strategist. We basically have these tables when it comes to basically how we look forward, how specific factors impact our investments. And I showed the same slide at the BCI Roadshow, but I think it's important just to look at how the mood has changed. So if you look at how much red and amber there are on the slide, this is 2023, and how that is completely changed into 2024. And we don't necessarily make an investment decision just based on this, but this is a significant overlay, and it creates ideas for us with regards to where we need to look, what lens we need to put over our SA equity ideas. And I'll give an example of that. So on the load shedding side, and this is something that I think a lot of asset managers have been highly focused on. So when we look at the load shedding side, obviously we've engaged with the Energy Council. We've had some nice no load shedding days for a very long time. The reason why the September to December is amber, and next year as well, is that our engagement with the Energy Council alluded to the fact that you might get load shedding from 1 to 3 going into next year, and maybe 0 to 2 stages, 0 to 2, the beginning of next year. So for us, it's quite important to look at that and realize how our companies are going to be affected given that specific factor. Now, the sensitivity, how sensitive that is to the company's earnings. But with that said, our head of research, Patty David, so what she asked all the investment analysts to do, or the equity analysts to do, is to look at their companies that's under their research coverage and look exactly how they were affected, how the company was affected with regards to load shedding and how that's going, what the delta is going to be for next year. And the interesting one from that, and I'm not sure if the audience knows this, but one of the companies that came out that was the most affected is Astral Food. So that's obviously the poultry producer, and they also do feed. And I mean, the load shedding was so severe, or the impact from the load shedding, that they went into quite a significant loss, and actually they always were cash, well, mostly they had cash on the balance sheet, and they actually went into debt. So that's a good example of how we look at what's going to happen and how it's going to reverse if something positive happened. To be fair, the load shedding was, the impact on Astral was very indirect as well. It was direct, and then indirect when it came to the bottlenecks with regards to their birds having to stay long on the farms, and they called it the big bird era. But be that as it may, that's an example of the load shedding. Then on the rate cut cycle, I think we're all quite aware of what's happening in South Africa, what's happening in the US, and I mean, just what happened in China. But I just wanted to allude to that. I actually looked this morning at the FRA curve. So FRA is the forward rate agreement, so it's derivatives that financial institutions quote on. Maybe it's a 12 by 15, or so it's usually for 3 months. And the interesting thing is I looked at this 12 times 15. So what rate you can secure 1 year from now for 3 months, and it's currently 6.9%. If you go back a year, not even a year, but 10 months, that was closer to 8%. So you can see that there's some significant cuts still coming. Close, I mean, the FRA curve is pricing in basically 1.1% cut going 1 year forward. But I mean, I think everybody in the audience probably knows that. Obviously, it won't be 1.1%, will be in 25 increments most probably, but that's just basically what the derivative market is telling us, where the rate cycle is going. Then on the earnings, I think everybody is aware of what's happening with regards to the just corporate SA in general. But just to share maybe a few things on the RMB conference that we attended. So when we go to these conferences, we attend quite a significant amount of meetings, anything between 50 to 60 meetings with corporates. As I said, we send a whole team down. And the interesting thing around this is last year, when we attended it, we had 16 neutral to negative or negative views on the companies that we met with. And usually what we do is we're quite quick with regards to response to our fund managers. We usually give them immediate feedback as we walk out of the meeting, and we basically have a 5-rate classification system, and that gives them an idea of whether the story is still positive or negative. And last year it was 16 neutral to negative or negative stories. This year it was only 4. So you could clearly see the mood shift going more positive. People have got a lot more confidence what's going on the consumer spending side, which is obviously the next item. That's a 2-pot system. So quite a lot of positivity baked into what's happening. So that's more to the rating. We're going to see that coming through in the earnings as well. Then on the SA risk premium, I'm just going to touch on this briefly, and then we can go to the next slide. I looked this morning, the 5-year CDS spread is currently 183 bips. Brazil is 155. And you can just see as things go, as time moves on, as Cyril Ramaphosa is having speeches that's more positive around the economy. There's so many positive things that's happening on the GNU. Maybe in the background, there's not a lot of things that's clear cut at present, but you can clearly see the directions is going quite positive. And if you see the CDS spread over the past, I would say over the past year for South Africa, it's come down quite significantly. And you can see that in the bond prices. The sovereign bond curve also went down. And if you look at Brazil is 155 currently, but there's not a clear trend downward. So you can see that South Africa in the EM space is becoming a much more attractive opportunity compared to some of its peers where it's competing for capital. Then one of the themes that we're specifically looking at, which we're quite positive, is the mid cap and the small cap space. Now, I just quickly created this chart to just illustrate a point. So on the left-hand side, the axis is the performance of the mid cap index, and on the right-hand side, that's GDP growth. Just note that the zero is slightly higher than the zero on the right-hand axis. Zero is slightly higher than the zero on the left-hand side. But what I wanted to illustrate is when GDP growth is above 2%, there's a tendency for the mid-cap space to outperform quite significantly. And the easiest way to see this is what happened in 2003 up until 2006. I'm not exactly sure we're going to get back to the 4-5% GDP growth. That's definitely not what I'm saying. But what I'm saying is that there's a lot of work that's being done to get South Africa back to that 2 to 3, maybe even 3.5% GDP growth. And once that happens, the mid cap and the small cap space tends to do very, very well. And that is where we are hunting for ideas. So that's just one of the things I wanted to highlight to the audience, that there are some interesting ideas in that space. Another thing that we look at is corporate activity. Now, looking at some of the deals that's been done, we were quite active in that as well. And then on the right-hand side, some of the deals that could happen. Obviously, we rank it according to low, medium, and high probability. But the way that we use this a lot of times is that when we've got a fundamental valuation of a company, and even if a deal doesn't occur, this is a nice asymmetric return in the event something happens. So looking at this specific chart or the specific slide, on the left-hand side, and specifically talking around the Best Ideas Fund, three of the companies on the left-hand side are in the Best Ideas Fund. And if I look at the right-hand side, 6 companies are on the Best Ideas Fund. And out of all of them, we met with every single company over the past 3 weeks, one of the analysts, except for one, and that one company we are meeting with either on Friday or on Monday. And that's actually Tiger Brand, so that'll be the pre-close. But with that said, I mean, I'm going to talk about Grindrod in a slide as well. That's also a company that we own in the Best Ideas Fund. But if I look at the probability of future opportunities for this company to have some sort of corporate action, it is quite high. We're very positive about the prospects of that company, and I'll discuss that in the next slide. So specifically talking about that in Grindrod, and this is the next theme that we're looking at. If you look at SA equities and where the state has provided the private sector with opportunities to grow or to increase market share or just to get more earnings, Grindrod was definitely in a situation where it partially benefited from the demise of Transnet. But with that said, Transnet is a key partner and it's key for Grindrod's future and for its future growth. Now, with that said, there's a lot of things happening at Transnet, a lot of transformation, rail reform, and Grindrod, as I mentioned, is definitely going to benefit from once they release the toll fees and they realize how much they need to pay. All the private rail operators, we're expecting that in October. And then there's also going to be a lease co, as well as the slots that's going to be available for the private sector to bid for. And something that Grindrod announced last week, and actually I was glad that we met with them literally the day after the announcement came out, is they increased their stake in the Matola terminal. So Matola terminal is at the Maputo port. Grindrod bought the remaining 35% stake in that terminal, so now it will own 100%. And the multiple that they bought it for, which is a historic multiple, is a 12p, which is, in the greater scheme of things, extremely cheap. And the reason I say that is, firstly, that terminal itself is going to grow. It's going to start producing more money for Grindrod. But we just saw a deal happen yesterday where a company, CGM, made a bid for 48% of Santos Brazil. And that PE, so that's a ports and terminals business. And the offer that they bid for is basically 17.9 PE. And if you start to impute some of these values on Grindrod share price, then you are seeing a significant uptick in the current share price. So we're quite positive around the future. It's got a very strong CEO. It's got a lot of tailwinds in its benefits. So it's one company that we're very, very positive about. Then looking at, just sticking to the themes about where the government falls, Stadio is a company we also met with at the RMB conference. This number of 446,000 students, that's up to about 53, and it continues to increase. But the main theme that we're playing in Stadio is just the academic offering, taking away some students from UNISA, which is the state competitor in the distance learning space. Now, to be fair, Stadio is going to aim for a 20-80 mix, 20% face-to-face, 80% distance learning. But the offering that they have is, I would say, is quite significantly better than you can get from UNISA. And you can see that in the one example I always tell people to look at is the SAICA pass rates. So SAICA, the South African Institute of Chartered Accountants, they release reports on how many students wrote the first board exam and how many passed, and from which institution. And Stadio's brand, which is Milpark, that's a specific brand that where they provide the CTA, which is basically what you need to do to write the board exam to become a chartered accountant. Stadio has now taken over UNISA as the largest producer of CAs in the country, which is quite a significant feat, and they just continue winning market share. So it's one of the companies that we're quite positive about going forward. Then on another one that we're quite positive about is Reunert. We also met with them. This is just a slide that shows some of the projects that's ongoing. But more importantly, if you think about Reunert is one of the companies that's really going to benefit a lot from this fixed capital formation, this renewable energy projects coming online, more to do with the transmission and distribution. And if you think about the transmission pipeline, I mean, it's essentially 5 years that these guys are going to have to provide high voltage cables. And CBI Electronics, or African Cables, which is a subsidiary of Reunert, one of the 3 big players in South Africa. And there's more than enough work for all 3 players to have a healthy pipeline going forward. So it's one company that we're quite positive. That's one division of theirs. They've got the defense division as well, which we're quite positive on. Full order book, and the rating of this company is quite cheap. It's basically forward of under 10 times. It's got a nice dividend yield, so mid-single digits dividend yield. So it's a company that we're quite happy about. And then moving over to some of the unique ideas and management, some unique ideas with regards to how we look at things. One key aspect which you want to create alpha, and it's a little bit trickier than other places, is if it's a company that's in turnaround or something that they need to change. Now, if a company to change and it is the same management team, that for us in our checklist is usually a red flag. So we like it if there's a turnaround and it's a new management team that's taken over. So one specific investment that we are in, we've in a few, and I'll mention all 3 of them, is SPAR. SPAR, we have met with the management team a few times. There's a pre-close call on the 30th, because a year into this in September. But the communication at the RMB conference was actually quite positive. They are definitely doing the right things. They have sold Poland. They had to pay in for that. They are taking out the debt on the South African balance sheet, but they're more than able to do that. And something just to allude to, because we engage with management team quite a lot. It's part of our ethos. It's part of our culture in over the capital. But with that said, we also do a lot of primary research. So 2 weeks ago, I was in Durban driving around to various super spas to speak to the store managers to find out how things are going in KZN. How's the loyalty currently? Is there anything that's changed? What's the concerns? And obviously you have to visit quite a few of these different super spas, but that just gives us a flavor of what's going on. So we don't, even though it's important to take what management says, you have to test it independently. And that's something that we take quite seriously at All Weather. But with that said, KZN with the SAP issues was a very significant problem for them. And it seems like things are going well on track for them. So that's part. Pick and Pay is another interesting one. There was management change. Theoretically, it's a much further back CEO that came back to do the turnaround. But I think Sean Summers has done so far a very good job. The Boxer listing that's around the corner is going to be very interesting. So I think they'll start to do roadshows in October sometimes, and the listing in November. But with that said, the Boxer price is, I mean, there's a range that it could be. But if you think about Pick and Pay's current market cap, and currently Pick and Pay basically owns 100% of Boxer, it can list anything between 30 to close to 50% of Boxer, probably close to 30%. But Boxer is worth more than everything else in Pick and Pay. Anything between 30 to 40 Rand just on the Boxer valuation. Once again, these are internal valuations, so take it from that perspective. But we're very bullish on it because we think it's going to do very well. And this IPO is going to also it's going to be very interesting because we've heard that a lot of people are interested in it. Just maybe a last thing to say on this specifically. The Pick and Pay balance sheet post this Boxer IPO is going to be net cash. So the risk of bankruptcy is completely removed. And if you think back at your finance days with Miller and Mogliani, that risk of bankruptcy or insolvency is something that has got an impact on the share price as well. So that's something that he's bought time, which is very good for that share. And then lastly, Tiger Brands is one that we are also quite bullish on. New CEO, Chart Creer, took over. Clear strategy that is communicated. The one reason we like management changes is because it communicates, well, first of all, are willing to change from the board, but or to affect the change. But more importantly, a CEO that comes in, there's no familiarity or sunk cost with regards to previous projects. So if a project from reassessment doesn't make the cut, they can make the changes and move forward. Whereas maybe previously the CEO, that was a bit of a pet project for him or her, and they want to keep it, that does create a situation where there's less options to turn this company around. So that's why a turnaround and a new management team in a turnaround setting is extremely important for us. And some other easy wins that is communicated is just the bakery utilization, procurement. I mean, one example that he gave us, once again, we meet with management quite often. One specific thing he communicated to us was how you run a bakery. So once again, Chart came from Premier long ago, so he knows bakeries exceptionally well. And how the Tiger Brands bakeries were run was they had specifically scheduled maintenance in different times, which is important because you need to maintain. But there's a specific time in the month where you need to run your bakery 100%. So just by adjusting the timing of these things, they're still doing, the frequency is the same, but the timeline is slightly different. He was able to increase the utilization by anything between 1 to 3%, which in a bakery makes a very big difference. And there's a variety of other things that he's addressed, which I think are very good when it comes to the Tiger turnaround. So we're quite bullish on it. We think he's going to do well. And once again, in this general GNU and better GDP growth, better consumer spend, we think that is going to have a very good, well, we'll see what the share price does, but we're quite positive on it. And that is my final slide. I think we can probably open it for questions.
Yes, thank you very much for that. Insightful indeed. Maybe if I can talk a little bit more about your investment process. I mean, we did speak to the two funds, the equity fund and the Best Idea funds, and I think you were very modest. Your equity fund that's been running for a longer time, you know, always in the top half. I've never even seen that fund in the bottom half. And your new fund, yes, short track record, but top quartile all the way around. But we'll keep that in mind. We'll keep on watching it. Let's talk a little bit about hedge fund thinking. And we've seen in the past boutique managers when you come from a hedge fund background. You've shown that one slide as well, where there's some hedge fund thinking come into it. But maybe unpack that a little bit more. You know, in a long-only equity space, what does that mean when you bring in hedge fund thinking?
Yeah, sure. I'll mention two examples, or two tangible real life examples that we actually implemented.
Yeah.
So the first, well, actually, I'll bring in three. So the first one is the most recent one, which we took quite a significant part in the best ideas, and also in our long onlys. But there was a book built in an AMS, an Anglo American Platinum, by Anglo Plat. So usually what happens, and I've actually spoken to some of our peers around it. So a lot of people in the long only space, depending on what style they follow, don't ever, it's a blanket rule, they do not take part in any book builds. Now, I think it's important that so usually what happens with these book builds, a lot of times hedge funds are the liquidity, not always, but a lot of times hedge funds are liquidity providers for a situation like this. They pick up the share a slightly lower price to the close, and then maybe they keep it, or they sell it out over time. Now, I think the important thing is we don't disqualify ourselves completely from doing these things. It's like I said, it's a hedge fund mentality. If it's a book build, we actually have a very, very good mining analyst. He's actually a mining engineer by trade. So we already have a valuation in mind of these companies when they come with a book build. So that's one where we actually took a decent stake in, because we believed it was a very good opportunity for us and for the funds, which was true. So the long only took part in it, the hedge funds and the more active funds took slightly more active part in it. But that's one example of how the hedge fund mentality is slightly different, or it adds a unique selling point for us. Second one that I think is also important is when it comes to hedging. So when people look at hedge funds, sometimes they only think about risk, and they think that hedge funds take a lot of risk, which I think in some cases it's true. I think for us at All Weather, it's not necessarily the case. We're very, very focused on risk management. And if you look at our funds, you look at the tracking error, you look at the volatility, you can see that from the actual data that it is much lower risk than you would expect, even compared to some of the long only products. Now, translate that into the long only space. When it comes to the hedging and protecting on the downside, and it's very specific in the CI space, you can't just go and enter derivative products. But we actually did a hedge. I just need to think when it was. I think it was about 2 years ago, where we bought a put option for the hedge funds, as well as for the equity fund, which Sunny runs, our deputy chief investment officer, and in combination with other guys, obviously, but he's the main guy. And that actually worked out exceptionally well for us. We could manage the volatility due to the derivative structure that we put in place. Once again, that's specifically for Sunny's fund. That was a risk management tool that he used. And for the hedge fund, it was also, but it's also a way that we can produce alpha, because obviously the exposures are different. And then lastly, the one that we did a few years ago, when that RB Platts Impala deal was happening, Impala had a situation where you could actually do an arbitrage, where you buy the RBP share price. Okay, so in a hedge fund, let me just make this clear. So in the hedge fund, what we did was we bought the RBP share price, we shorted in the correct ratio the Impala share price, and then we could just exchange it to the broker. And then what happened to the broker that was running the book for Impala? They gave us the ratio of the Impala shares and a cash component. So in the hedge fund, we could do this over and over and over until the pricing didn't make sense anymore, right? That's your classic arbitrage opportunity. For the long onlys, we did a similar thing, but we didn't churn it. We did it once. And to be fair, I think the fact that we could do it and we looked into that, I think some guys just don't even look at that. They just let it go. But it's something that, like I say, for hedge fund mentality, you look at things slightly different than you would versus if you're only in the long only space.
Bringing in opportunities in a different way into the fund, it does make a lot of sense. In terms of your investment philosophy, you clearly state that you are style agnostic. Do you think that adds value to be style agnostic, and how does it play into your investment process in adding alpha footlines?
Yeah, so I think, I just need to be clear. I think everybody in All Weather, when it comes to their personal style that they like, slightly different. Maybe one is or a quality bias, other ones more value bias. But I think the firm as itself, we've got quite robust conversations when it comes to, okay, what's going to drive returns for this share, for this fund? So I think style agnostic is important because you need to, I don't want to say the flavor of the month, because these things these styles are much longer term. And when I say much longer term, so one example that I mentioned now about the mid-cap space. The mid-cap space, if you start to look under that, and you look and you disaggregate the style from that, probably going to get a value style. Now, I don't think we look at it as a pure value style. I think we weigh it, or a growth style, or we look at it, okay, what is the intrinsic value of this company? Where's the earnings expectations for this firm? How does it compare to what the market thinks? Where's the market, in our opinion, wrong? And whether it's a growth style, whether it's a growth at a reasonable price, whether it's value, we don't really care where the alpha comes from. But I mean, we're very cognizant of, okay, momentum is working in these few quarters, value is working in these few quarters. And I think it's more important for us to look at the intrinsic value of the company, where it's going, where the catalysts are going to come from to drive the share price. Because the one thing I would say, and this is something that we talk about a lot, is it's easy to identify an undervalued company. I think the difficulty is to identify an undervalued company and to realize that it's going to reflect its fair value over a short or medium term. Because an undervalued company can say undervalued if nobody buys it, or there's no flow, or there's no catalyst. So I mean, we've seen that quite often, and that's also why we're quite active with regards to engagement and maybe agitate for change as well sometimes. But like I said, so there's a variety of different styles, but we're more focused on making sure that you can identify opportunities. Doesn't matter what the style is.
Picking up where the catalyst is going to come from, I mean, you might mention of the RMB conference, especially this year. I mean, the mood is just like 10 times better, very positive on SA and equities. With the Fed cutting aggressively 50 bips, talking about more rate cuts, obviously in months to come. Do you think it's going to be a turn towards more cyclical assets, capital starting to flow out of the US? And can you see places like SA being a benefactor of that? We haven't seen net positive flows into our SA equity market yet. Our bonds are net positive week on week on week, but we haven't really seen it on SA equity. Your views on that?
Yeah, so I think we're very fortunate to have in our strategist, Dick van Rensburg. So I think if you look at the emerging market space, and you look at how that's fared compared to the developed market space, the emerging market space has kind of been decimated when it comes to size of market cap and performance. There's some unique pockets. I mean, India has done phenomenally well. I mean, some would argue it's overvalued. I tend to be in that camp, but once again, it's a very interesting market when it comes to various macroeconomic factors. But when I look at South Africa and you look at whom the peer group are peers with regards to emerging markets, there's a lot of things to be positive inside South Africa. When it comes to the prospects of gross capital formation and everything. So I think South Africa being depending on what benchmark you use, 3-4% of that specific index, let's call it 3% of the emerging market space. People just have to start to allocate a little bit of capital towards South Africa, which has got a decent, I would say, quite significant tailwinds. And then you're going to start to see flow-driven asset price increases. We've seen quite a few foreign investors come to the RMB Big Five conference. I would say it's one of the few times when foreigners are starting to show interest again. I think they're starting to do work on that. There's a variety of different equity sectors that they would look at. I doubt they're not going to start at the mid-cap space. Obviously, there's going to be the large, more liquid side, because obviously if they start to do, I don't know, 50 bips into South Africa, we're talking quite significant flow. So there's only certain shares on the JSE that can absorb that type of flow. So I think it's quite positive. I think things are going to go well. But once again, this is a little bit longer term story. And we need to start seeing those flows, because as you say, Eugene, we haven't seen those flows yet.
Let's see, time will tell. You also mentioned China very briefly. I mean, end of 2022, 2023, beginning, big bells rang, China unlocking, this is the new era we're going into, and then everything fell flat and disappointed, and the property market collapsed, lots of problems in China. You did make mention huge stimulus packages announced over the weekend in China again. I mean, we know our mining sector, well, across the globe is intact as it's bruised and very depressed at the moment. Do you see additional stimulus in China really having a better impact on our mining sector specifically?
I mean, that's a little bit of a tricky question. I would, and the reason I'll allude to that.
Too early.
Yeah, I think it's too early, and I think that the aim of the stimulus is different. The aim of the stimulus is not to build more bridges and more buildings, and I think they've done that. So one of the key beneficiaries of that is obviously iron ore, and a lot of people are looking at that. We're definitely not bullish on iron ore, and that's a function of China, obviously. And I think the stimulus is more directed towards consumption. But it's going to be directed more towards consumption. So if you look at the wealth effect, where previously a lot of people had a lot of wealth in property, I think what the Chinese government is trying to do is they're trying to direct that more into creating more wealth in the stock market. And with that said, there's also, I think there's going to be a delayed effect. I mean, the share prices yesterday, I don't know if anybody was looking at the US, but there's quite a few shares, either US ADRs or some indices that they can look at, or ETFs like K-Walk and so on. And those things were running quite strongly. But to be fair, it's a very low base. So it's not, you don't have to get too excited for it to run 10%. But I think it's slowly moving towards starting more positive. And I think a lot of people there's been a lot of discussions over the last 2 years for people that manage emerging market funds to have an index that they measure against as EMX China. So I think a lot of people they're looking at China slightly differently. From our perspective, I think the focus is going to be more on the stock market as well as the consumer market. And I think they announced the 500 billion buying program for the equity market. I need to just check my notes. But it's quite significant. And like I said, that's why it's so important to have an in-house investment strategist, because he guides us towards where the flows are going.
That's a lot of things. You've briefly touched on property. I know you've got a property fund as well. You've got a range of funds. So you do look at property. But do you look at SA property in your equity allocations at the moment?
We do. Once again, we've got two of my colleagues on that fund, so Chris Reddy and Jared Housen. So they run the fund. There's very specific shares that they like within that space. We do have in the best ideas fund, and as I say again, maximum of 25 ideas. I just need to check, but I think we've got three REITs in there. And it's once again that there's very specific themes within that REIT sector as well.
Sure.
Some are going to do well. So if you look at the earnings growth and we've got a distribution growth, some of the bigger names is a little bit more muted than the others. They've run quite hard for good reason. But yeah, I don't think there's only once again, I think it's very specific on the stock picking side in that space. We are bullish on it. But it's similar to, I almost want to say, the banking sector as well. Banking sector has run phenomenally hard. You need to choose your horse quite closely. And you can do that for every sector, right? It's not just property.
Well, if we look at your numbers, it certainly seems as if the process are working. Cobus, that's unfortunately all we have time for this morning. It's been really, really great to have you on these sessions again. You've been very clear and precise on exactly what All Weather does. Definitely a contender to keep in mind when you do allocate to equity. Cobus, thank you for your time this morning, and we hope to see you a lot more in future, and All Weather Capital as well. To our audience, you know how it works. If you need to get more information or hold of Cobus, let us know, and we'll get you in touch or get the right information through to you as well. Thanks, Cobus.
Thank you, Eugene. And yeah, if anyone wants to get in touch, please, it's either myself or Jade. We're more than happy to help.
Do like that. Just to our audience, quick reminder, next week, Wednesday, 2nd of October. Can you believe it? Going into a new month. We've got Mazi Asset Management and Vunani Fund Managers. Looking forward to seeing you all again next week, Wednesday morning, same time, 2nd of October. Thank you so much for attending and your contribution. We'll see you soon.